Hi guys, in this lesson we are going to be talking about currency pairs, what is a currency pair, how you trade it, what actually makes it up, why you need to know about it, and we'll also be going over the bid-ask spread. So on this first slide here, I want you to pay attention to this chart right over here. So this is the one that I want you to pay attention to. It's basically the cheat sheet that is going to show you all the combinations of some of the combinations of major currency pairs. And we'll get to that in a second. But as you can see, for example, the euro is actually EUR when you're trading in foreign exchange. And it's same as the Japanese yen. Its code is JPY. And then again, you've got the Australian dollar, which is AUD, right? That's what it is. So when you put these pairs together, it won't be Euro Australian dollar. Of course, it's going to match its symbol. It's going to be either EUR, USD, Great British Pound. It's going to be all of these things within this circle here. So if we just stop for a moment and we go on to the next slide, what we can actually see is a more in-depth, detailed look at what a currency pair is. Now, this first current part of the currency pair here, if we look at this part, it is the base currency, right? And we go to the second part, the USD, it is the quote currency. Now, what this basically means here is that this first part, the euro, the base currency, well, that is what you're going to be buying. Whereas this second one, the quote currency, is what you're going to be selling. That's going to make a bit more sense in a moment here. And at the very end, and we'll get into this, this is the pip. This highlighted number 6 right here, that's just a measurement. We don't need to take into account too much what a pip is, because everything is going to be calculated for you within the foreign exchange. So let's just get rid of that, and we can go and have a more in-depth, detailed look over here. So again, we can see that on this chart here, that's what I want you to draw your attention to. Great British Pound, the first one, is the base currency. As I said, or it's the currency you are buying when you trade the Forex pair. Whereas the second one, the quote currency, the USD, is the currency that you are selling when you trade the Forex pair. And if we actually go ahead and have a look at a live chart, let's go on to Great British Pound USD. This is going to make a bit more sense. Let me just clear these indicators away for you. So when the market is going up, as we can see over here, this entire area, we are obviously buying Great British Pound. Why? Because if we go and look at this price over here and look at this right-hand side of your screen, the price there is 1.05. Now, what does that mean? That means that one Great British Pound buys $1.05 American. That's what it buys. Whereas here, it's gone all the way up to 1.14, so $1.14. So when it's going up, it makes more sense to buy Great British Pound, because you buy in here for the low price of $1.04, and then you move up here to $1.14. You make 10 cents when you sell everything, because you bought it at this low price, then you sell it really high. That is what you're doing with this currency. Whereas when you are selling it, when it's falling down, you wouldn't use the Great British Pound. You're using the US dollar. Because as the US dollar falls, what you're basically doing is borrowing money from the bank. And again, we'll go into a bit more detail here. We're borrowing money from the bank, and when you sell it basically at all this price, you come up here, you get it down here, and then you give it back to the bank. Again, we're going to go a bit more detail into that, but it's all about that second one, because what we're basically saying here is that the US dollar is now falling. It's not actually that, also the US dollar is going up, I should say, because if the US dollar is going up, the Great British Pound is usually falling. Or it's staying still, And the strength of the US dollar is going up, which means, of course, can buy less and less and less with your Great British Pound. So remember, just as a recap here, when it's going up, your Great British Pound is gaining strength, and when it's going down, your Great British Pound is losing it. So then you sell your US dollar because that's probably going up in price. So that is what a currency pair is. We can see so many different variations, guys. These are all the ones that I trade, for example. If we just look over here, so to this part of the chart there, but you can see so many examples and so many different combinations. That's what we were talking about originally, that you can trade. And it goes on and explains it a little bit better over here. So what we're going to be looking at is this part of the table now, right? So draw your attention to there. So major pairs are basically made up of the Commonwealth. So you've got Australia, England, Canada, for example, and then you've got the European nations. So you've got the euro, you've also got the Swiss franc, and then of course America and Japan. These are the economic powerhouses of the world, right? So they have a really great, stable and strong economy. That's why they're a major pair. Now, minor pairs are technically any currency pair containing currency outside these major pairs. I'm pretty sure the SGD is a Singaporean dollar, but we would also say that these pairs have a stable economy. It's just not strong. For example, the New Zealand dollar or the Swedish krona, really good, strong, stable economies, but they just don't have the overall momentum. They don't have the volatility. When you think of the US, you think of really rich, a lot of volume. They've got a lot of money in circulation, right? They've got great import-export trade. Does New Zealand have the same amount? No, not really. Doesn't have the population to support it. That's why they're a minor pair. But that doesn't mean every pair out of that is a minor pair. We can then come on to exotics. So it's basically a major currency against one form of smaller emerging economy. Now, this doesn't include minor pairs, right? So if you had NZD-USD, which is the New Zealand dollar versus the US dollar, that's not an exotic pair. What we would be looking at here is something like the Polish zloty or the sterling versus Mexican peso just here, or even the euro versus the Czechoslovakian whatever currency that they have. And then again, regional pairs, we don't need to know too much about it. It's just pairs that are right next to each other, euro and Norwegian krona, and the Australian dollar versus the New Zealand dollar, that kind of deal. So that is what currency pairs are, and hopefully that makes quite a lot of sense to you. Just coming out of this now, if we can hop on to the BidAsk Spread, we're going to go to our old friend Baby Pips here to give us a bit of an example of what it is. This is very important because it's going to help you when you come to trading. If you have a high BidAsk spread or you don't know what the BidAsk spread is, you have the potential to lose out on quite a bit of money. So please pay attention to what we are going to be going over here. So the ask price is also known as the offer price, but think of it either way. And it's the difference between the buyers and sellers' prices. So this BidAsk spread is the difference between the buyer and seller's prices. As we can see here, that's 1.4. It's always measured in pips, right? So if we went back to our original slide that we were talking about with the number 6 there, that's a pip. So just think of it as centimeters or millimeters. It's just used to measure every time the market goes up and down in price. It's just measured in pips. It's just measured in pips, right, guys? So the spread is the transaction cost. So what we're going to be looking at here is a bit of an example. We're going to skip all that stuff and we're going to go over and have this simple analogy here. So you see a car you like and you inquire about the price. Car dealer asks for $20,000, and that means that the car dealer is willing to sell you that car for $20,000 because he's asking for it. He's saying that's $20,000, and it's the same as in the market. Right before we were on the Great British Pound, we saw that it was 104 at one point. That is the asking price. They're asking you to buy in at that price. But say you are interested, but you want to trade in your current vehicle, a truck. the dealer bids 5,000 for the truck. Notice how the bid price is from the perspective of the car dealer. This means the car dealer is willing to buy the truck from you for 5,000. If you think you get a higher price of the truck, you're free to get bids from other people as well. Other brokers in this case, when you're hopping into the market. Instead of having that as $5,000, someone might offer it different. So when you're hopping into the market and you see one at $1.04, but you can see another broker's offering it for $1.03, $1.02, but you think it's going to go up to that $1.14. Now you understand that you have the ability to not make 10 cents, 11 cents, 12 cents, and so on and so forth. So your Forex broker is like the car dealer. So you apply to these same concepts in Forex, which is exactly what we've been talking about. In summary, the spread is the difference between the buy and sell bid price quoted on your trading platform, and is payable on the closing position. So whatever the difference is between that buy and ask price is what that dealer is going to make in commission. So if you have a massive difference here between the buy and the ask price, you're going to miss out on quite a lot of money there, because that's going to be $500, $600, $700, and that's commission that is going to go to the dealer. So the smaller that gap is, that bid-ask spread, the better it is for you, right? You want it to be as close together because you don't want to have the difference being, for example, in this, 15,000. Because that's the difference. That's the spread on the bid-ask price. Anyway, guys, I hope that made a lot of sense to you. If you have any questions, again, I'm sure you'll be able to reach out and contact us. We'll be happy to help you. But until then, I will see you in the next lesson. Thanks, guys. Bye.